Today we're going to talk about what the smart money knows about most retail traders. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to be talking about what the smart money knows about most retail traders. When we sit down and we look at the Forex market specifically, we know that roughly 70% of the market, the biggest traders in the Forex market, 70% roughly are banks, the bigger players in the market. So then there's also hedge funds, central banks, other financial institutions that are moving the markets. Us as small retail traders, we're actually trading the price that we see on the chart. We're not the ones moving the market. But what the smart money knows about most retail traders are some reasons that I have a list of things that I have typed up, and occasionally I add to it if I make another mistake. But I review that real briefly in the morning with my playbook, my best playbook trade setups, and I've started a new chapter with my perfectly executed trades. And one of the things I'm striving for, and one of my short-term goals, is one trade at a time to just flawlessly get my perfect trade. And what I mean by that is that I've got some criteria in terms of my entry. I want to time that as perfectly as I can based on my criteria. I want to take the correct position sizing based on what I'm currently trading. I want to then manage that trade as flawlessly as I can to either its profit target. So again, even setting my profit target. I mentioned recently some other videos. I've noticed where I've made a few measuring errors. I'm working on hitting that target measurement perfectly, or exiting perfectly if that target's not hit and I get a reason to exit that trade, and then also journaling afterwards, taking my screenshots, doing everything from start to finish, one trade at a time, as perfect as possible. And the reason why that is that we get caught up into what we've done or what we want to do, and we sort of lose sight of the meat in between of just focusing on the pure process of trading. But one thing that the smart money knows about most retail traders, and we talk about, most retail traders lose, 90% supposedly. I think it's 99%. Maybe there's 5, 6, or 7% of traders in there that make some money, lose some money, make some money, lose some money. But I really think it's only 1% of traders that make the really big money. And so I'm just going to review a couple things that I look at each time, and I'll if I'm waiting or just prior to the market open with London or end of day, I review one more time just to remind myself before I take a trade that it doesn't fall into any one of these traps that the market knows that most retail traders are going to make. And so it's constantly a game of cat and mouse of trying to lure traders into the market to be positioned or trapped into the other side of taking positions that eventually become liquidity for the bigger players. So number one, they use too much leverage. I've been guilty of this. I've talked about blowing up other small trading accounts. Size and too much leverage aren't the same thing. Size is relative to what you're comfortable with in terms of trading, relative to your overall capital. Too much leverage is based on whether it's your account size or how much trading capital you've allocated to that account. So you might not have it all in your account, but you might have a certain amount that you've allocated to trading, and you might be trading based off of that. But then, for example, in some cases, some traders are opening up small accounts, and that's all the money they do have, and they're using 50% of their account to try and make big money on every trade, and eventually that blows up in their face. And the markets know that. That's why a lot of these brokerage firms give some traders up to 400 to 1. In European markets, they've tightened that up, and I think in the US they're looking at doing that as well. But just an example, they know how losing traders think. They want to use too much leverage. A lot of the indicators, different systems, trap traders. They move markets into market opens and closes, Asia, London, New York. They will draw traders in to short-term or what looks like breakouts or trends. They trap them into buying high, and they trap them into selling low before the market reverses and stops them out. A lot of retail traders will get into the market and they see the market moving towards their stop, and people say, oh, that's just noise. And if you've read Al Brooks's books, he'll tell you that every single bar on the chart represents something, and it means something. There's no such thing as noise. There's buyers and sellers at every time frame. Do not move your stops. If you have a trade, you've taken a reason for entering the market and you've picked a level technically where that trade will be invalidated, don't move your stop. They know that traders will move their stops because why? They don't want to lose. They don't want to be wrong. They know that traders, because we work at home, we can freely pick and choose when we can move our stops. We chase trades. So the market explodes out on an announcement or just randomly it breaks from a level. The candle hasn't closed, but we don't want to miss it, so we jump into the trade. In the last 30 seconds of a 5-minute candle or at the hour or whatever it is, it reverses and completely runs down to the other end and closes opposite to where that started. And you'll see this often just either at the Asia close, London Open, or sometimes into the New York Open as well. Do not chase trades. They know we'll average into losing trades. That's the mentality of a losing trader. We know that 90% of traders lose. I've done this myself several times, and those are the types of situations that can end up blowing up your trading account. They know that retail traders will hold on to losers because they believe that it'll come back, or they hope that it will come back. If you're thinking in any of this, so far again, as I go through my trades, if I see any of these types of things showing up in my trade, I'll look to exit the trade right away. If I already recognize that I've impulsively entered a trade, which hopefully I'm not doing that anymore, but again, they hold on to losers. They'll also get into trades where finally they're profitable and they're so excited that they haven't been stopped out or tricked and they've got a winning trade, they just want to get out right away and scalp some of that money. So they don't let their profits run. They cut their winners. They don't have a clear exit strategy. You'll see lots of different systems and programs being sold and courses where they're using multiple indicators. The smart money loves that. They want traders to have bright lights on their screen, lots of lines, lots of indicators, because they think that they're going to be able to use those indicators to better time and predict the market, but ultimately, again, same sort of thing. They are lagging. They will draw you into traps. And again, not all the time. That's the one thing to understand about the indicators, is that there is a time and a place. But again, the industry knows that the more they can move the market on shorter time frames, the more that they can draw traders into losing positions. Trade randomly, no trading plan. Again, we talk about this in the 7-step daily routine. If you haven't done so, go to my homepage, download it. It's an audio file. Start creating the daily rituals and disciplines, working on the vision of the trader that you want to become, having a trading plan, journaling, goal setting, all the little things that are going to help you moving in a direction of constant progress. They know that retail traders are going to be impulsive. They're going to be impatient. They'll sit there and keep a market in the doldrums, up and down, not really moving it anywhere, and then they'll explode it to maybe one side and it may keep trending, or it'll reverse and go to the other side. But they know that traders, retail traders especially, if they're working full-time, they're trying to trade around their job or anything else. They want to be able to take a trade when they can get on the screen, so they're impulsive and impatient. Number 13, they know that retail traders are impulsive, impatient, and they also are emotional, and they'll try to get even and get revenge. So they lose some money right away, they double up, take too much leverage, and they try to make all that money back on the next trade, and they end up taking a bigger loss. If you're making some money and you're winning, they know that retail traders will become overconfident, and then they'll start taking trades outside of their trading plan. They'll start trading randomly, or they'll take on too much leverage again, or they'll move their stops because they've been profitable in the other trades and it just needs a little bit more room to breathe before it finally goes. They'll hold on to a loser. And when that overconfidence comes, it breeds other errors in your trading. They know that most retail traders are fearful. So again, they'll drive the market up. It looks like it's an explosive move on one of the market opens, and it immediately reverses on the next bar. Traders would never want to sell high or buy low into momentum, but in often cases that may be within a trading range, and the market can turn around and reverse strongly the other way. They know that most retail traders are hopeful. They again will hold on to losers. They'll hope that they'll come back. They'll hope that they don't get stopped out. They hope that the market, if they average into a losing trade, will at least get back to where they can get out at break even. Again, emotion. They don't treat trading like a business, so they don't have a trading plan. They have no capital management rules. They have no methodology for managing or tracking the markets. They don't see trading as taking trade after trade after trade, taking a 1 hour loss, 1 hour loss, 1 hour loss, having a positive expectancy, 1.7, 2.3, 3.1, whatever that is. But they don't focus on trading as a business because they're emotional and they have their hopes and dreams attached to the outcomes of every individual trade. 18, trade live before you are ready. So they do a course or they read a book, they take a few demo account trades, boom, they made some money on the demo, so they're going to go live. They start trading live and they really haven't had the screen time or the hours into the market to really understand the different types of conditions that will present, the volatility, the movement, the average true range of the instruments that they're trading perhaps, or the different instruments that are trading, the relationship of economic news releases, all those sorts of things. That takes time. It's like riding a bike, professional bike riders. Regardless of how they want to do it, they need to spend time in the saddle. And number 19, overtrading. So we talked about that a bit in the other ones with overconfidence, overtrading, taking trades outside of their plan, all the things that they know are errors that retail traders will make, and again, largely making your own list. You know, the reason I talked about making that perfect trade was that I know that all of these errors, if I see myself making any one of those errors, it's easier when you start to write things down and on a trade-by-trade basis know exactly what you're looking for, and you start to archive your perfect trades one at a time. Then you know you don't need to do any of these other things because you know what your trading process requires of you. You know what you need to do. No one's going to hold your hand. No one, even if somebody gives you a trading signal to buy or sell, it's irrelevant unless you can execute the process from start to finish. And that's where your mindset needs to be, is flawlessly executing your trading plan. If you enter into any one of these errors, that's where you're taking your money and you're giving it to them, which is exactly what they want you to do. So think about that. Remember who you're trading against. The market isn't just this ethereal thing. You are trading against the smart money, especially in Forex. Other markets are a little bit different, but Forex especially, they are there to take your money. So have your own list, review it daily, work on your mindset, keep practicing, keep going bar by bar with your methodology, sharpening your edge, getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.